In a bid to tame rising inflationary pressure, the Monetary Policy Committee of the Central Bank of Nigeria, in its recently concluded MPC meeting, raised the benchmark interest rate from 14% to 15.5%. This latest move represents a 150 basis points increase from the 14% voted during the last meeting in July. CBN's governor, Mr. Godwin Emefiele, during his briefing at the end of the meeting, noted that the cash reserve ratio, which means the share of the bank's total customer deposits kept with the central bank as cash, was also raised to the minimum of 32.5% from 22.5%, hereby retaining the liquidity ratio and asymmetric corridor, which let's take a listen to the words of the CBN governor after the briefing yesterday. Or at the briefing, I beg your pardon.
They cannot give any assurance to anybody that we will not continue to raise rates, because we've seen rates move recently very, very aggressively, and that is the reason we are following it up in the May, in the July, and now the September meeting, very aggressively for us to ensure, to see to what can be done to rein in inflation. So if you want to see the success in reining in inflation, you have to try as much as possible to raise your rate to a level that is equal or possibly even higher than inflation, so that your inflation rate must lag your policy rate.
Well, let's discuss this more, and I'm being joined via Zoom by the Chief Executive Officer, CFG Advisory, Mr. Tilewa Adebajo. Thank you so much for your time. It's good to have you on the program. Yeah, while I would like to ask, what were you expecting at the end of that two-day meeting? But the central bank governor has come out to say that they had no choice than to continue to just increase the rates, as that's the way they can rein in inflation at this time. I don't know if you agree to that economic policy being instituted by the central bank.
Yes, first of all, when you talk about the problem being inflation, you also have to ask yourself, first of all, what is the cause of inflation in Nigeria today? If you take a look at the 25-year analysis of inflation in Nigeria, in 2006, inflation peaked at 28%, almost 30%. And by about 2007, 2008, thereabouts, we had a low of 4%, just below 5% inflation. In the last 25 years, that's been the high and that's been the low. Right now, we're at a 17-year high for inflation. So what you have to ask yourself is that even before you take a decision, what are the drivers of inflation in Nigeria today? Aggregate demand is not a factor in Nigeria's inflation. It's not an issue of demand pull, but more of a cost push inflation, which is affected by diesel prices, energy prices going up. Food prices also is a key driver of inflation. And the third factor, which was not mentioned, was the ways and means financing of close to 25 trillion. So those are the three drivers of inflation in Nigeria today. So if you increase the rates by 150 basis points, which is standard macroeconomic strategy for taming inflation by increasing rates and trying to curtail the demand for those funds, what would you impact? You might impact food inflation. You also might impact the energy prices. But the fact is that that will not impact the ways and means financing of close to 25 trillion. And therein lies the elephant in the room. But clearly, I think it's because real rates are also negative. That's another issue that is clear. And you need to be able to adjust rates to be able to reflect the erosion of value or inflation. So all in all, I think there are no surprises there, but we need to address the causes of inflation.
But I'm still looking at inflation at 20.52%, according to the NBS, and it's still higher than the policy rate as it stands. Some say this might be injurious to the economy in its totality. What else can the CBN do at this time? Just asking your opinion around this.
Well, they need to rein in the ways and means financing. That is another problem. The Ways and Means financing is at 25 trillion. If you look at the cash reserve ratios now going to 32.5% on deposits in excess of about 55 trillion, you're looking at about 17 trillion naira in which they are trying to sterilize. But if with the special notes they have, they are using that money to finance government through Ways and Means, then the net effect will be zero. Inflation is already at runaway levels. And if that process continues, then they need to do something about the Ways and Means to bring down inflation. If you take a look at the pattern over the last 3-4 years, last time inflation went down to about 18%, the central bank was able to bring it down to about 11%. But all of a sudden, when you think it's going to go back to single digits, something happens and they lose control again and it goes back up. So they know how to bring the inflation down. And I think they've done it before twice in the last 5 years, of bringing down inflation from a high of about 17 and 18% down to 11%. The challenge with the central bank is they've not been able to sustain it at those lower levels. So I think they know what to do, and historically, I think the numbers are there that has proven what they have done over the last 5 years.
Let's look at some of the interventions now from the monetary side, which some say needs to be complemented on the fiscal side. A lot has been done one way or the other to various sectors from the Central Bank of Nigeria. In your assessment, will you say this is paying off one way or the other, or do we still have some time before we start to reap fruits of this investment, some of these interventions?
Well, one of the biggest intervention, I think over 2 trillion, I don't know how much it is, but quite significant intervention has been in the agricultural sector, a lot of the Anko-Borrower schemes and all kinds of interventions in the agri sector. There has been no impact on food prices, and we see food inflation as a key driver of inflation, high rates of inflation at the moment. So in that area, there's definitely no results. And I think that the central bank needs to start winding down these intervention programs and begin to, push those assets to the development banks, either the Bank of Agriculture, the Bank of Industry, or the Development Bank of Nigeria. So all these intervention assets should now be pushed to these 3 banks, and they have the capacity to manage them properly. And they will also have the capacity to take on only those assets that they feel are in good shape. So I think the CBN should move on and shut down this program.
How worried are you also with regards to the FX space? Yes, I know you must have spoken about this at different times, but how worried? Because yesterday the central bank governor talked about the non-oil sector generating at least a little bit more funds than we used to have before now. Also, the aviation sector is heavily impacted with issues around the FX, scarcity of FX. What also do you think can be done, and what's your assessment of proceeds from the non-oil space? Are we doing well? Can we do better?
Well, first of all, you have a spread of about 65% between the parallel markets and the official exchange rate. I think one is early 400, the other one is 720 or 725, depending on who you talk to. Now, what this presents is a massive opportunity for arbitrage, and it doesn't give anybody incentive to do anything productive in the economy. And the argument has been that the central bank needs to move away from a static exchange rate mechanism into more of a market-driven economy mechanism. For instance, oil is trading at $100 a barrel. So at this point in time, Nigeria has a competitive advantage, and Naira should be appreciating against the dollar. But if you have a static mechanism, then you lock yourself into a situation whereby your currency just continues to devalue, never appreciating at the appropriate time. So there's so many distortions in this market with the multiple, not only having a static exchange rate mechanism, but you have multiple windows. And time again, the central bank has been advised to shut down these windows and have a singular window. And this has been a challenge that it has not been able to address and you can begin to see the impact. So the monetary policy now is like the central bank said that tomorrow is going to debit the banks if they don't fund their accounts appropriately with the 32.5 CRR. So he's expecting to, improve his debit position on the CRR levels by tomorrow. And if he says if they don't respond by Friday, it's going to bar them from the foreign exchange markets. So I think that's a signal that he needs to mop up the excess liquidity that will otherwise be chasing the dollars in the system. And hopefully he can use that to cool off the demand for dollars. And hopefully the dollar rates will drop and the spread will begin to close a lot more. But I think you need to do more than that because we still have $25 billion coming in from diaspora remittances on a yearly basis. And it's important that that money comes in through the banking system. If you have a distorted exchange rate, those funds will going to end up in the parallel market and not the banking sector.
Almost finally, global issues are also affecting Nigeria's growth. Of course, a country that is struggling already. Russia and Ukraine crisis. We can go on and on identifying some of these challenges. And at the same time, low oil production. Our output remains low. We can't even meet up with OPEC quota. So what is your outlook for Nigeria's economy? Some say that as we move towards December, we might see a reduction in inflation figures. That might be good news. I don't know if you think that would happen.
Well, it's too early to say. I think the policies are in place to begin to slow down inflation. Like I've said, we know the three key drivers of inflation. That is the ways and means financing, which the central bank has direct control over. Food prices are more difficult for them to control, and energy prices. So by raising interest rates, they expect to be able to tame inflation with a food price increase and energy prices. That is what the 150 basis points reflects. But the ways and means financing is what they need to address to be able to realize that's where we can make most of the significant impact in terms of inflation reduction. So I think in terms of the prospect of the Nigerian economy, the biggest challenge to the economy now is the fiscal side of Nigeria. The Nigerian government is insolvent because its revenues can no longer service its debt obligations. And we have $100 billion in the debt profile at the moment, $60 billion of that being domestic and $40 billion being foreign. And on top of that, we have 25 trillion naira worth of ways and means financing that we have not accounted for officially. So it's important that these debt payments has become a systemic risk because it is no longer sustainable. And if we're not careful, we might need to go for an IMF bailout because we no longer have the revenues to service our debt obligations, not to talk about meeting recurring expenditure, and not to also talk about meeting our capital expenditure. So as we speak at the moment, the federal government of Nigeria is in violation of the Fiscal Responsibility Act, which says that its deficit should not exceed 3% of GDP. We've exceeded that significantly with the deficits we have now. The CBN Act is also clear that any money that government borrows must be paid back in the same calendar year, and any lending to government must not exceed 5% of the previous year's revenues. That also has been violated. So not only are we in violation of the Fiscal Responsibility Act, we're also in violation of sections of the Central Bank Act. So it is important that we correct that before we enter into a debt crisis going forward. So the challenge is fiscal, and there's need for significant structural reforms to be able to get the economy back on track.
Now, finally, World Bank warns of a global recession, of course, tying it to the rising CBN rates all across the globe, and everyone is doing that. But they're also advising that we should target reliefs to vulnerable households instead of tightening monetary policy. I don't know, do you think that would also work in Nigeria if we are to target vulnerable households with reliefs and maybe handouts and all of that? Can that help at this time, Mr. Tilewa?
I think you should understand that your problem, the problem is the federal government of Nigeria is insolvent. Revenues cannot even meet debt service. So if you're in that kind of situation, how do you go to that next level? How are you going to fund those programs? So you have a situation where you can't pay your debt. So you are now going into deficits to borrow for your debt and also to borrow to pay salaries. So you need to address your debt crisis. You need to restructure your debt, and you need to get into structural reforms. That is a priority. If you don't do that, nothing else is going to happen. So monetary policy, at the end of the day, if we're not careful, by the end of the year, is going to become very relevant and effective. Because the fiscal issues and the fiscal challenges have overwhelmed the Nigerian economy.
Well, it's a good way to leave it. I must thank you so much for your time. Chief Executive Officer, CFG Advisory, Mr. Tilewa Adibado. Thank you so much for making us understand all of these developments across the financial space. Thank you, and do enjoy the rest of your day.
Good afternoon.